Mark Collinsworth with us here from Vere Global, talking about cycles in the stock market despite outside events such as coronavirus, black swan events, things of that sort. And you say that this may be the salvation for us now coming out of what's happened because of coronavirus. Mark, explain what you mean by these cycles, which I believe last every 18 years.
Correct, Larry. If you go back and you look, there's actually long-term bull markets and long-term bear markets that last roughly on average about 18 years. So if you go back to the start where I did my research, starting in 1910 to 1928, that would be defined as a secular bull market or a long bull market lasting for 18 years where you get double-digit returns. So for that period from 1910 to 1928, you average 10.65. Once that cycle ended, the new cycle, which would be a secular bear market, starts. You get single digit returns. So from 1928 to 1946, that only annualized 2.1%. Then from 1946 to 1964, you averaged 12.24. And then from 1964 to 1982, you averaged 3.7. And from 1982 to 2000, you annualized 16.76. And this is what surprises a lot of people. Starting in 2000, a secular bear market started, which means for the next 18 years, you should average subpar returns. And this surprises people, but from 2000 to 2018, you only annualized roughly a 3% annualized return in the stock market.
So, therefore,
Therefore, since we just came off of 2018, we should have a new secular bear market because the secular bear market just ended. A secular bull market should start, which should run for the next 18 years.
despite the effects of coronavirus.
Correct. I believe the coronavirus and other events like that are simply hiccups or road bumps inside the longer term of the bull market. If you go back to the beginning of each one of these cycles, like the start of 1910, the start of 1928, the start of 1946, the first 2.6 years of each one of those cycles had a big bump in the road. And then from there, once you got past the bump, that's where your long-term bull market actually develops, or even your long-term bear market starts.
How do you explain, though, that these things occur seemingly naturally despite any of these intrusions of coronavirus or other curves that are thrown to the stock market and knocks it for a loop, at least for a while? I mean, how do these natural cycles occur?
I think, a lot of things are run by math. Um, like, let's say the pi number, as you learned in high school, 3.14. Another guy by Martin Armstrong actually took this one step further and broke it down where looking at the market every 3,140 days. And according to his work, a market low should have occurred in 1985, another one in 1994, another one in 2002, another one in 2011, and according to his work, a market low should occur in 2020. Just to really blow your mind on pi, if you take that same 3.14, if you take a river and you measure out the curvature in miles of a river and then draw a straight line from the beginning of a river to the end of that river, you should work out to the pi number of 3.14.
And this isn't just hocus pocus, this actually can be demonstrated from
It can
past.
actually be demonstrated. It's actually math. Well, if you think about it in the forms of rivers, when rivers, pi is just simply a function of a circle. Well, rivers actually curve around and around. So they actually create semicircles as they curve around. So it's just natural that they would form a circle and would have a derivative of pi derived from them.
Yeah, it seems obvious to me.
Doesn't it?
Actually, it doesn't, but I'll take your word for it. So, according to these natural cycles and your calculations, which you say are verified because of the past cycles in the market, we should be emerging now into a new strong bull market. How soon?
Usually, the average on this runs about 2.6 years to go through the hiccups. And of course, throughout the 18-year cycle, there's going to be multiple, hiccups and road bumps throughout it. But long term, for that 18-year cycle, you're in good shape. Roughly, if I had to guess, you're probably somewhere towards the end of that cycle. I would probably say we're looking probably at the second half of this year is probably when we'll start seeing much better times. Um, and going back to your theory on why these cycles actually exist, of course, everything's based on math, but I think it's probably a little bit more human psychology. It's ironic that, the cycles run out to about 18 years, and children become adults at 18. How are their spending habits actually affected when they reach that adulthood? What kind of things do they start buying? Are they more inclined to start buying homes? Are they inclined to start families, buy cars, get out on their own? Could the 18 about an adult being 18 years old have an effect on why that cycle actually exists based on their spending trends as becoming an adult?
All right, so that's kind of like a generational thing every 18 years, yeah.
Correct.
All right, but now cite to me some of the past cycles where the market was hit by something similar to coronavirus, and yet because it was within that cycle, still recovered into a bull market. What are the past examples of that happening?
Well, look at 1987. 1987 was actually inside a secular bull market. You had a stock market crash very similar to what happened here. Market sold off roughly, 30 something percent, and then it recovered. It was just a hiccup in the market spectrum. Another interesting thing before I forget, Larry, going back to the pi number, if I took the pi number and actually double that, which works out, 3,140 days is what, 6,200 and something days, which also is very similar to the 7.6-year cycle that we've been talking about. But I went back in time, and it actually puts you right. It puts you right in the middle of 2003, and ironically, it puts you almost within 10 days of the peak of the SARS pandemic that broke out in 2003.
Well, I mean, this is just really incredible that it works out that way. So, your advice to nervous investors, are trying to, maybe heading for the hills, want to sell everything out, go to cash, blah, blah, blah. You're saying there is definitely a big light at the end of the tunnel.
Yes, Larry, I think there's a big light at the end of the tunnel, but like the saying goes, it's always the darkest before the sun rises. So
let me ask you this. I forgot to ask you this. Now, considering these cycles and how they work even in bad times, what about the Great Depression? What part of a cycle did that occur in? And did the recovery coincide with that 18-year cycle? That would be a prime example of whether this actually works.
And I have the answer for you, Larry. So the secular bull market, which gives you double-digit returns, lasted from 1910 to 1928. That gave you a 10.64% annualized return for that 18-year cycle. Well, the stock market actually...
Yeah, the market was roaring then. The roaring 20s. Yeah.
The market was roaring. So the secular bull market ended in 1928. Well, the stock market for the Great Depression topped out in 1929. So from 1929 to 1946, 18 years, you only annualized 2.1% on your stock investments.
And then the recovery came as we went to war.
Correct. When that 18-year cycle ended in 1946, in 1946 to 1964, you went back to double-digit returns, which was 12.27% for that 18-year period.
All right, Mark. I mean, this is really fascinating, and I hope accurate. But you say you could chart it out on paper as it's occurred time and time again.
Well, you can, and basically, it really comes down to numbers. I think there's a reason why a lot of your ancient secret orders had so many things that were based on numbers. Why Stonehenge and the pyramids were so particular about basing them on certain sets of numbers throughout history.
Now, Mark, in the interest of full disclosure here, are you a member of any secret organization?
I might be, Larry.
No comment, huh?
No comment there, Larry.
Very interesting. Assuming that you are, then you do have the inside dope on how these cycles work. So, Mark,
I didn't learn all these things about numbers from just reading books.
Wow. To be continued. Mark Collinsworth, the CIO of Vere Global. Thanks for the enlightenment.
Thank you very much.